Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 50th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're going to get creative. We're titling this one, Welcome to Episode 50.
Hey, you do only 50 once, right? So
exactly. You know, we'll talk about some of the, I mean, obviously a lot of fun that we've had with this podcast and what we've learned from it. Again, we just recently hit more than 25,000 downloads, which is a big milestone. Like less than 10% of all podcasts ever have that many downloads, and obviously most podcasts don't ever even make it to 50. So we're honored to do that. But before I even go there, I have to talk about something. 2 days ago, I forget what I was doing. I was reaching somewhere and I gave myself a paper cut. And I'm telling you, like as I just sit here, this is 2 days later, it still stings. It just looks, and it's not like a little one. This is like the whole size of my finger. I don't know how I did it. I mean, I haven't had one in a long time, but I probably should be putting stuff on it to help it heal. But nonetheless, you had a paper cut in a while. I haven't, and it's just really frustrating.
What makes it especially frustrating, it's from a place you don't expect. Like if you're handling a knife or something, you cut yourself, like, par for the course, as they call it, right? Like, of course, you're not careful. You cut yourself while you're chopping vegetables or something like that. But a paper cut is like out of the blue, and then it's annoying, it's frustrating, and it hurts. I think that's the problem there. Mm-hmm. It's partly mental.
Yes, right? Yes. Frustrating, annoying, and it hurts. I mean, there's a lot. I was thinking, like, I felt like being like a Bengals fan for the longest time, but then we got Joe Burrow. But anyway, all right. Well, Sonu, there's a lot to talk about here. We'll again, this is episode 50. We're honored that so many people continue to listen to this weekly podcast here, Facts versus Feelings, titled "Welcome to Episode 50." So we're going to touch on, due to the holiday, we're actually recording this after the jobs number on Friday. So we're going to talk about that jobs number that just came out. Also, Sonu, you wanted to talk a little bit about consumption, which continues to be strong. Then we're going to talk about the idea of, is slowing data or weakening data actually a good thing? We've seen some little bit of slowing economic data, not a recession, but slowing. What does that all mean? Then we're going to do a little fun with the podcast, what we've learned doing 50 of these. Then we're going to finish it up with September. September is the worst month on average. Just turn on TV. They've mentioned it 1,000 times already. Is it true? And could we have a big drop? But Sonu, again, the jobs number came in this morning. I've got it here somewhere. I've got all these papers in front. I was joking with you and Chelsea, our producer. Yeah, but I was joking, like, we would have maybe one less because I was going to maybe, my daughter would have killed me is what I'm getting at. She had to pay this fee in order to cheer tonight on Friday. And I guess we missed it. I got 3 kids. Everything's busy. And somehow I missed it. It was one of the more complicated things. I mean, we manage models, right? We do podcasts. We do video. That's easy. That is really easy compared to paying $175 online for my daughter to cheer. But I'm pretty sure I just did it minutes before. Like you had to run last week to the podcast because you dropped your kids off. Kind of forgot. I had to get that done right before the podcast. One of these days we should just be nice and smooth and calm going into it.
It's funny you just mentioned that.
Let's get into it.
You just mentioned signing up for your daughter's stuff, and that I just thought of it, that I have to sign up my girl, my six-year-old girl, for Girl Scouts. So I need to do that today.
Oh. You just want to buy the cookies. You can't fool me. Yes. You just want those cookies. I know how that goes. Those are good. I mean, we've bought 1 or 2 of those. All right. So, Sonu, let's talk about the jobs number this morning. 187,000 jobs created, ballpark 170, 175, depending on your source. Better than expected at the headline. But we saw some revisions from the previous 2 months and a big jump. I'm going to say big jump. That's what the media is calling it. Big jump in the unemployment rate from 3.5 to 3.8. As of now, stock markets are hanging in there in green a couple hours after it came out. What's your takeaway? Now you had some time to digest the monthly jobs report.
I was thinking about this, and we came into the year, we titled our outlook The Edge of Normal. And then we updated that,
Yep.
a month and a half ago and said, things are normalizing, right? All the data has gone, as we thought it would kind of go, which is rare, actually. But, it's gone in the right direction as far as we're concerned, right? And that's kind of what we were expecting. And this payroll report is literally a continuation of that. In fact, it sort of like puts a stamp on it saying, you know what, things are normalizing. If not, I don't want to say like it's normal, but it's definitely normalizing, right? We're much closer to it. And, you take the revisions. Yes, June and July were revised down by about 110,000 jobs. It's not great, but that's why you always want to look at a 3-month average, right? So you take the 3-month average, that's about 150,000 jobs. That's a lot more than the economy needs to create just to keep up with population growth. It needs about 75 to 100,000 jobs to keep up with population growth. We're a third above that. That's pretty good. That's pretty solid. And let's talk about the unemployment rate that jumped from 3.5%, 3.8%. Why? Now, the BLS, the Bureau of Labor Statistics, when they measure unemployed workers, or, when they count them, I should say, not measure them, when they count them, they're looking at workers who are so-called actively looking for work, right? So you have to, file papers, whatever it is. You have to say you're actively looking for work. You can't just say, oh, I'm sitting at home, I want a job. That doesn't count. You have to prove that you're actively looking. And last month, or in August, it turns out 736,000 people came back into the labor force, right? That was the largest number of people who came back into the labor force since January. It's a massive number, right? And obviously the labor force size is about 167,000, something like that. It's 167 million, not 1,000, right? But so many people came back in the labor force. Why did they come back? Because usually this happens only when the labor market is going, when workers are confident that, what, this is a good, healthy labor market. I think I can find a job, and I'm going to start actively looking for one, right? So when the BLS counts them, they're like, oh, okay, suddenly we have a lot more people who are unemployed. But it's just the fact that they came back in the labor force, decided, you know what, come August, things are going good. I'm going to look for work. If you're close to a recession, usually if the labor market is not in a good place, we actually see the opposite. More people just get discouraged and they stop looking for work, right? So that's one reason. I mean, you and I have talked about it. We look at the other side of the unemployment rate, which is the employment population ratio, right? You look at the number of people employed as opposed to the number of people unemployed. You look at the total number of workers employed as a percent of the civilian population. And, there are a lot of baby boomers retiring. So to take out the impact of that, you look at prime age workers, right? 25 to 54. That ratio, that metric, prime age employment population ratio is at 80.9%. That's the highest in 22 years, right? So just by itself, like that tells you that the labor market is probably in the healthiest place it's been since the late 90s. I'll give you one more stat, and I'll stop talking. Prime age employment population ratio for women, 75.3%. That is a record high. Nobody's talking about that. That also tells you how healthy this labor market is, especially for women. Even for men, for that matter. You shouldn't say that it's just for women, but it's just that women prime age employment population ratio is at a record level.
Great points there. So in a way, like we talked last week about yields going higher, we thought for the right reasons because the economy was strengthening. Unemployment rate, I should say, just went up a little bit again, maybe for the right reasons, because 736,000 people. Now, also, we did see hourly wages drop, or no, sorry, wrong way to put it. Came in a little light, up 0.2%, expected, eased. There's the word I'm looking. It's Friday. It's a long week. Eased to 0.2% from, maybe that's something you can say when you learn from doing 50 podcasts. You learn certain little words to pull out when you get there. My favorite one's like you're on TV and they ask you something and you have no idea. You have no clue what's Greek debt going to do? You're like, oh, I don't know. Mine is, you know what? That's pretty important, but actually, here at Carson, we think, and then I tell them what I want to tell them. That's my little thing I do to get out of jams. Yours is use the word
media
ease.
Training for all of us from Ryan Detrick.
Yeah, media training 101 right there. But anyway, let's get back to it. Hourly wages, again, eased to 0.2%, expected 0.3%. This kind of is a segue almost to something else I wanted to talk about. Just the idea that things are still good. The economy's growing, but it's slowing a little bit. I mean, the Fed wants to see that slow, right, Sonu?
Yeah, look, if you just think about the economy overall, right? We'll get into wage growth. But in
Mm-hmm.
2021, nominal GDP, right, grew about 10 to 12%. There was no way that was going to continue. A lot of that was because of inflation. I mean, that's
Mm-hmm.
just not the place you want to be. That slowed to about
Right.
6 to 7% last year, 2022, right? And we're continuing to, we'll probably get to maybe between 4 and 6%, maybe 5 to 6% this year, right? So there is a little more of a slowdown. It's not a bad thing. That just means a lot of it's inflation's coming down. That's one thing, but it's still strong. Slowed. I think one thing a lot of people are missing is they're confusing slowdown with, oh my God, it's just going to continue going down and we're going to get
Right.
into a recession, right? Whereas what you and I are saying is
Mm-hmm.
slowdown is just normalization. And I think there's
Yes.
enough data points. You just mentioned employment population ratio for one. There's enough data points out there to tell us that it is in fact normalization, as opposed to putting us at the edge of a recession, right? And then you get into wage growth. Yeah, wage growth is running, before the pandemic, right? For wages were running about 3% at an annualized pace. Right now, they've eased. They were running at close to 7.5%, 8%. This is why nominal GDP was so high, because workers are getting massive income gains. Right now, that slowed. That slowed to about 4%. Right, and then it gets back to okay, that's not a bad thing. You obviously always want workers to gain more. But the other side of that, the Fed looks at it and says, you know what, we don't want them to gain too much because then we'll raise rates and we need to slow the economy and all that. So we're kind of in that good, I don't want to say perfect because nothing's perfect. What's the word? Goldilocks type of place, as they
There
call
it
it
is.
in finance, like the Goldilocks place where it's not too hard, it's not too soft. The Fed can be like, you know what, we don't need to raise rates anymore. So September, they're probably not going to raise rates. They've said maybe we'll raise rates one more time in December. I know you and I think, especially more so after this latest jobs report, I don't think they need to.
Mm-hmm.
Things are normalizing and things are slowing just enough. That doesn't mean we are at the edge of a recession.
Yeah, I mean, as of yesterday, the odds of a hike in September was 11%. I'm not sure where it is the second you and I are doing this, but it's probably lower, right? It's probably going lower. Again, we mentioned the revisions lower. So June was revised lower 80,000 jobs, 108,000. July was revised lower 30,000 to 157,000, but still creating more than 100,000 jobs. Then this month obviously popped a little higher. Who knows? Maybe this month gets revised lower too. But those are still showing growth to keep the economy going. Last comment on this, I thought this was interesting. It reminded me of what Neil Dutta joined us a few weeks ago, one of the most listened to podcasts we've ever done with the Facts versus Feelings. Go check it out. We talked about manufacturing and the idea that the soft data, the surveys were just continuing to say recession, things are bad. Yet the hard data is strong. And he said, listen, who are you gonna believe, right? Who are you gonna believe? 300 purchasing managers or like hundreds of thousands of corporations? And here's what I'm getting at. Manufacturing jobs last month, Sonu, up 16,000, expect to be up only 4. And that was the highest number we've seen since October of 22. So manufacturing is still hiring, running counter to those surveys that we keep seeing.
And on
anything
that
you want
point,
to say else on that before we go forward? Yeah.
Just a couple of things. Like when you think manufacturing, you're thinking about the cyclical part of the economy, right? So to that, construction, you talk about housing and, non-residential construction, factories, all of that. Construction added like 22,000 jobs. Over the full year, they've added more than, year to date, first 8 months of the year, they added more than 100,000 jobs, right? That's not what you would see if you're close to recession. Right, forget in a recession. I think we can comfortably say we're not in a recession, but for, let alone being close to one, right? And then last month we also had this weird issue that there was the Hollywood writers' strike, so the motion picture industry lost 17,000 jobs as well, right? So that dragged from overall job growth.
And Yellow Truck, right? The large shipping truck company, they went out of business also, and that's potentially skewing some of the numbers along with Hollywood. But Sonu, we've as usual, I'm always like, do we have enough to talk about for 30 minutes? And quickly I realized, yes, we do. We need to move forward. So jobs number kind of came in, didn't really rock the boat. Let's talk about consumption. You did some really good work on some of the data that we just saw from consumption. It appears that the consumer remains really, really strong. Real consumption in July up 0.6%, expect to be up 0.5. Headline consumption up 0.8, expect to be up 0.6. I'm sorry, expected to be up 0.7. That was the best number in 6 months. I mean, the bottom line, the consumer continues to surprise most economists to the upside, does he not? Or does she not, maybe? They
No.
not, is what I should say.
They maybe mostly he probably.
They.
And but look, consumption, and this is data through July, right? I'll tie in, I'll tie in what we saw from the employment report as well. So it's a nice, combination there.
Yep.
Through July, over the 3 months through July, so you're taking May, June, July, consumption rose at an annualized pace of more than 4% historically. And this is after adjusting for prices. So this is real consumption, right? Adjusted for inflation. Before the pandemic, 2018, 2019, that was 2%, less than half of that. We had double the pace, right? And now you think about, okay, let's tie in what we just saw with the payroll report, right? And now that's because it's August data, but the consumption numbers he got were through July, right? Where does consumption come from? We've continuously talked about that all year. Income, right? You need real income growth. Income grows faster than inflation. So incomes comes from three places, basically. If you look at overall aggregate income, how fast is employment growing? How fast are wages growing? And how many hours are workers working? All three went up in August, right? In a pretty good, strong, solid way. So I'm just looking at the numbers. Weekly payroll growth in August over the last 3 months, right? 7% plus at an annualized pace, 7% annualized pace for weekly payroll growth. So you adjust that for inflation. Inflation is running just over 2% over the last 3 months. You're looking at real income gains over about 5% over the last 3 months. What do you think that's going to do to consumption in August? And that people are saying, oh no, we are at the edge of a recession. Come on. That's all I can say.
That's all you can say. Just throw the mic down. Drop the mic, as they say. Just a few things. Again, this came straight from what we call Sonu's daily notes that you send out to our more than 350 partners. Over the past year, disposable income up 7.2%. Employee comp up 4.7%. Compare that to PCE up one of the Fed's favorite measures of inflation, up 3.3%. Bottom line, incomes and wages are growing more than inflation. And that's something you tend to see when the economy is healthy and strong. All right, so let's kind of move forward because we need to. What else we're going to talk about here? Oh, the idea of data slowing, right? We had the JOLTS data last week came in, slowing more than expected. We saw ADP. No, sorry, wrong one. GDP. I'm getting all mixed up with all these things. GDP was revised a little bit lower. This jobs number we just talked about, they did revise some of the previous months. So things are slowing a little bit. We saw huge drops. I'm talking like one of the largest drops in a 2-year yield over a 2-day period we've seen in years last week. Also, the 10-year yield came back to earth a little bit as well. Again, suggesting, hey, maybe the Fed is done because the Fed wants to see things slow down, not stop, not crash, but slow down. Tell me about that. Is that what we're seeing, you think?
I think what happened in July, between June and July, we got the string of really hot data and into part of August. Now we are in September, right? And the Atlanta Fed GDP now, for example, went up to almost 6%, like the nowcast for Q3 GDP growth, right? Look, there's no way, the U.S. economy, after adjusting for prices, growing at 6%. That would be amazing, but I don't think that's happening realistically. So I think even half of that, 3%, 3.5% would be really good, right? So things had to there had to be some give back. And that's what we're seeing, right? Yep. I don't think it's like a slowdown. It's just things are normalizing. And that's what we saw in the JOLTS report. The JOLTS report, for everyone listening, is job openings and labor turnover survey, right? Job openings have come down, but they're still much higher than the pre-pandemic level, right? They've come down, 9 million, something like that. They're down a lot from last year. They were running at about 11 million. So labor demand has softened. It's normalizing. It's not crashing, right? People are quitting their jobs less than they used to last year. So because of that, wage growth is coming down because, you normally quit your job, find another job because you expect to get a higher pay. There's less of that going on. Again, normalization, right? We're back at the same place. Workers are quitting their jobs at the same pace they were before the pandemic. Again, normalization.
No, great points there. It looks like 8.8 million was what the recent JOLTS number was. That was the lowest since March of 21. Expected to be about 9.5 million. Again, well over 11 million at the peak that we saw recently.
Right.
So again, that's good. Now, explain this to me, because I hear this and I don't always totally get it. So I want to make sure the listeners understand it. We hear a lot from the Fed about job openings to unemployed. It was up over 2, this time a year ago, give or take. It came in at 1.51 from 1.58, lowest in September 21 again. So why does the Fed care about job openings to unemployed? And it is going lower, so I guess that's what they want. What is that exactly?
Yeah. How geeky can we get? Not too much. I won't get too geeky.
Yeah, not too geeky, but yeah. Bottom line, how about this? The Fed wants that number to keep going lower, and it is. There. Is that all we want to say?
Yes. Yeah. Look, that's called, in economic parlance, jargon, whatever you call it, that's called the vacancy ratio. The number of openings there are relative to the number of people unemployed, right? So that vacancy ratio, if that's high, that tells you there's a lot of demand for labor, right? At the same time, unemployment is low, so that means supply is low. And what the Fed was saying up until last year, and earlier this year too, that, vacancy ratio is too high. It was close to 2, right? As you mentioned, at its peak. That means there's a big imbalance between supply and demand. And that's why inflation is going higher, right? And this is their model, this is their theory, right? But what's happened is that, that ratio has come down to about 1.5 right now. Before the pandemic, it was 1.2, so we're still above that. But, I wouldn't put too much stock in that. The Fed does. Powell likes to talk about the vacancy ratio. Though interestingly, over the last couple of press conferences, he's not really mentioned it too much, because, like I said, things are normalizing. I think they sense that too. Now, the good part, Ryan, is usually when the vacancy ratio comes down, what does that mean? There's less demand for labor. That means things are going into a recession and the unemployment rate increases. What's amazing in this over the last year is that, forget the fact that the unemployment rate just went from 3.5 to 3.8. That's for weird reasons, right? Good reasons, as we just talked about. That vacancy ratio has basically fallen from 2 to 1.5, and the unemployment rate hasn't moved too much, right? In fact, less than historically, the unemployment rate for the U.S. has been between 4 and 5%. Where we are, even after the August jump to 3.8, is still in a good place, right? And like I said, that's for good reasons, because more people came back into the labor force and were counted as unemployed. So, I think we couldn't ask for, better news on so many fronts, really.
Yeah, in a way, it's just like everybody expected, right? To see the vacancy rate going down, but unemployment not soaring. That's what everyone told us was going to happen, but it hasn't happened. All right, so Sonu, we're kind of winding down in the 50th episode of Carson's Facts versus Feelings. Welcome to episode 50. Let's talk about podcasts in general. You and I started this podcast right about a year ago, right? We've done about one a week here for the past year, but this is our 50th, so that's a pretty neat neat milestone, I guess we'll say. We're going to talk a little bit about what we've learned. I'll kind of throw one out there and you can go from there. I mean, I kind of knew this, but it was I had a podcast in a past life, and it's just a reminder to how powerful voice is. I mean, so many people reach out to me, and I know you, and say, I love your podcast. And what I continually hear, and there's a few of you that don't like it, the banter, right? Now, I know sometimes we talk too much sports, but most people really like the back and forth. I look at the podcasts I love. I mean, I'm a huge Animal Spirits fan. I love Animal Spirits. My favorite part's when they just start bantering, talking about what they're watching, what they're reading. I mean, I like the other stuff, and we kind of do that, right? We try to make it fun and entertaining, hopefully knowledgeable, and sharing what's going on out there in an easy to understand way. We're not institutional. We're not trying to be institutional. We're trying to make it easy for people to understand what's going on out there, and in a fun, playful way. I kind of knew that 50 episodes ago, but it's really been hammered home to me that is how people like to learn, at least from a podcast. Believe me, you can be institutional and talk all high level to somebody else, but for what you and I are doing on a podcast world, I think that's exactly what people want. How about you? What's your takeaways over the past 50 episodes?
I think you kind of mentioned one thing I was thinking about, which is it's been a great avenue to hear from people about what they, their response to what we're talking about, right? And when you hear a voice, you feel a little more connected, I feel. And then I've gotten a better appreciation for stories, right? And when you're bantering like you and I do, hopefully there's a story that comes out, as opposed to, look, we could give data all day long, right? But there's feelings too, hence facts versus feelings, right? So I think of facts versus feelings as more like a vibe. I mean, it's never like you should take only one or both. I think a lot of people say, you know what, I follow the facts. But it's really about feelings too. A lot, it's about how people, we're talking about the economy. It's about how people feel about the economy, how people feel about their job prospects. And that gets to, we're just talking about animal spirits. It gets to animal spirits. That's a positive feedback loop for the economy. You and I go out and spend. You spend on your daughter's cheerleading fees. I spend on my Girl Scout cookies and registration fees, all of that. But it gets to the whole thing about, feelings as well. And so I think from the podcast perspective, it's been great to hear from people, hear their reactions to what we're talking about. And I feel like we're in a good place where there's a nice feedback loop going on, right? We hear from people and, say, oh, let's talk about that on the podcast, right? Like some of our advisors have asked us questions about like debt and, corporate bankruptcies and credit card debt. And this has been a nice avenue to, talk to people about what are our thoughts on that, right? Whether you agree with it or not.
Yeah, well, hopefully you don't always agree with what we say. That makes it fun. But you mentioned I had to pay $175 right before we started for my daughter's cheerleading, and I didn't necessarily do that, Sonu, so she could cheer. I did that so she wouldn't kill me, because if I didn't do it and she couldn't cheer, so it's a fine line there. Anyway, the other final comment. We could talk all day about the podcast, and it's so much fun, and we just love the listenership and the sense of community that it obviously creates over time as people listening to us over and over. But I think I've really enjoyed some of the guests we've had, right? Not all podcasts let have guests. I mean, I'll be honest, there's compliances. Oh my goodness gracious. What are they going to say? What are they going to do? Right. And different hoops you got to jump through, different people inside of a company. So, well, you can't have him because then you got to have her, or vice versa. I mean, you and I have the luxury to invite who we think are really interesting people that the listeners are going to want to hear from, the honest to God, I want to hang out with and you want to hang out with. We want to talk to them about this stuff. And I think that's, we don't always have guests on this podcast. We've heard you loud and clear. You like it. I think our top 5 listened to podcasts ever out of the first 49 were guests. I don't know what that tells us, but, it's fun. So we'll continue to have what we think are the very most unique and fun and best guests that we can get that want to join us. The other thing is, it shocked me. Like, we send out a little, hey, you want to come join us? Like, within 5 minutes, I think every single person said, absolutely. It's not like they say, let me get back to you. Let me think about it. Like, people want to join us and do what we do. So that's been really fun. All right, so
some exciting guests coming up, right, Ryan?
Oh yeah, we do. I mean, let's not giving them away. I don't think we're gonna give them away yet. But yeah, we absolutely. Well, because we're going to Nashville. We talked about this before. Excel, our big conference with well over 1,000 people, financial advisors. A lot of our partners are going to be there. We have some. Maybe we can give it away. Who knows? I mean, maybe for the listeners. So we'll. Sure. We have Cliff Astis from AQR. And that's going to be awesome. Who else do we have? That's one of the pod. That'll be a live one. Who else do we have?
I think we have our first return guest in Sam Rowe too, along with a couple of other. We have Frank Capilleri and Paul Hickey from Bespoke.
Bespoke. We're calling that the Super Pod. There will be all 5 of us there. And then Alejandra, one of the best economists out there, called Alejandra because she's like Madonna. Alejandra from NDR. She's an incredible economist. I tried to hire her in a past life. She's so good. I mean, I think she's awesome. So anyway, so Alejandra as well. So we're going to pre-record or record some future podcasts for this Facts versus Feelings when we are in Nashville in 2 weeks. And hopefully we get to sneak away and have a milkshake or two. I know there's a really famous milkshake place, and it's one of those places that you don't just get a milkshake. There's like a hamburger on top of a steak, on top of bacon and eggs, on top of your milkshake. I'm joking, sort of. Everything.
Hot chicken. I'm hoping to get some hot chicken in Nashville. Maybe between that.
I'll tell you, I keep getting. I mean, I know it's my job. Everybody's like, come here. I'm like, I just want a little free time to walk around the city by myself. So hopefully you and I can sneak away at least for an hour or two, Sonu, and enjoy the city. It's going to be a busy couple days, but also an awesome couple days. And we'll fill you in very, very soon on that. All right, Sonu, final things is September. We'll talk about that in just a minute because I've got some notes literally on my phone, so I want to make sure I have them. You went to a concert recently, and I went to a concert recently. I don't think we talked about it. You saw Guns N' Roses in Chicago a couple weeks ago. Give us your summary of how that concert treated you.
Yeah, I mean, I've been a fan since, ever since I started listening to music way back in the late 80s. So I never got a chance to see them when they were when the full band was together and all of that. And then obviously I play the guitar, and so Slash is special in terms of somebody you look up to, and so it was amazing. Ever since he got back into the band, I mean, it's not all the original members, but Axel's there, Slash is there, Duff's back as well.
Yep.
He plays the bass, and yeah, they played at Wrigley Field. Was it last week? Last week, and it was a fantastic concert. The Pretenders were there opening for them. They were Chrissy Hines was amazing too. So yeah, but watching Slash, I mean, it was worth it. Axel's voice, I think, has been he's older, right? And but just watching Slash there going at it for 3 hours plus was phenomenal.
Oh, that's pretty neat. I saw Guns N' Roses in 2016, I guess, here in Cincinnati. They were around, and we saw them, and that was a neat one. I grew up liking a little louder music. I actually was in Denver recently, saw Pantera. Pantera hasn't toured for over 2 decades, a little more heavy metal, but that was amazing. Jamie Hopkins, managing director on the team here, he was out, and Jamie and I went to that concert together and had an absolute blast. So anyway, yeah, we're helping the economy by going out listening to some music. All right, Sonu. It's a noise. My dog's... My 150-pound, well, you know what? He's lost some weight. My 130-pound Great Pyrenees over there, he's like, I don't know what he's doing. I think he's having a coughing attack. Hopefully you don't hear that. But if you do, that's that dog over there trying to bark. He gets all choked up when we start talking about September, which is where we're going to end things. Okay. Although I think when we end, you're gonna break out. Are you gonna play a little music for us to celebrate the 50th, right? Maybe. Yeah. Okay. I should have teased that a little more at the beginning. So just a couple things. You're going to hear all over TV how September is the worst month of the year. It is on average the worst month of the year, down about 0.7% on average since 1950. I think February is the other month that's negative. So it is weak. Pre-election years, September is the worst month of the year. But I just want to throw a couple things out here, Sonu. And again, I did all these on Twitter, so I'm just going to read it from Twitter. There's a neat one. To me, it was like if the year is really bad heading into September, that's when the banana peel comes. That's when trouble comes. Years that were down at least 10% going into the normally weak month of September. 1974, September lost 11.9%. 2001, September lost 8.2%. 02, down 11%. 2008 down 9.1. Last year, stocks are down 10% going into September, down 9.3%. So that right there is interesting, I think, if you ask me. The other one I wanted to point out here, we had a really good year. We've got a really good year going. When you're up 10% for the year, so now we're kind of the opposite of what I just talked about. When you're up 10% for the year and August was down, so you kind of have a little sell-off ahead of the normally bearish month of September. Sonu, 8 of the last 10 times, go back to 1950, September was higher. Up an average, up a median of 2.6%. So again, there's a lot of ways to look at this. I think I've got one more here. This is final one. This is interesting too. At least I think it's interesting. So hopefully you all do. Remember, this was the best start after 7 months since 97 for the S&P 500. So previous years, they were up at least 17.5%. Going into the normally bearish month of August. I talked about this probably a month ago, how August usually pulls back. Well, that happened this year. August has actually been down the last 4 times before this year. This year makes it 5 times in a row. August was down when you're up 17.5% coming into it. Here's the good news. What does September do? The previous 4 times, September was higher after that seasonal weakness in August, up 3.5% on average in September. So again, you're going to hear all about it. My personal take, I don't think September is going to be all that bad. Maybe we just kind of consolidate, chop around. I wouldn't be shocked at all, honestly, if we gained a little bit this month. Maybe nothing major. But again, just that seasonal time frame. Don't panic. September is bad, but some of the things I just mentioned hopefully can calm those fears. So I know this is probably more my segment than yours. That's why I did it. You want to add anything there before you bring out your whatever you're about to do to end the 50th episode?
No, that's great perspective. It's funny, the mental image I had as you went through all that was because you mentioned banana peel there. I'm picturing this vague stock market personification just walking through the months of January all the way through July and then slipping on a banana peel. But no, that was, those numbers are awesome. It's nice to be reminded that this is normal. Right? It gets back to that. You wrote a piece earlier this week.
Yes.
You know what? August weakness is normal. September weakness would be normal too. But, that's not what, from your numbers, it doesn't seem like what we may actually get, despite everyone saying, oh my God, September is the worst month of the year.
Right. You know, something else. I mean, honestly, has anyone ever slipped on a banana peel? Like, honestly, I mean, first of all, I don't know who my boys leave stuff all over the place. I've tripped on many things from them, but is a banana peel even slippery? These are questions that I don't have the answer to. If any listeners have ever slipped on a banana peel, please let us know. Believe me, I've slipped before. I fell before. I've cut my finger. I got this. Literally, as you and I do this podcast, my paper cut. I'm just tinkering with it because it just hurts. Anyway, all right. Well, everyone, we are about to wrap up the 50th episode of Carson's Facts versus Feelings. We probably went a little long this time. Sorry, we just started talking, and it's what tends to happen. I don't know. I've lost track of time, honestly. Yeah, but at this time, Sonu has been working on.
I don't know if I've been
a little music. Well, you've been thinking about some music to end our 50th episode. I'll just be quiet. Thank you, everyone who keeps listening. Sonu, bring us home.
You may recognize this soon.
Okay.
It's acoustic rendition.
There we go.
I feel like my fingers need
tell us who it was. That was good. That was good.
I think
you want to tell us who it was.
Yeah, like since we grew up in the 80s, since we grew up in the 80s, and you know, growing up with Rocky, and I was like, I Have the Tiger, and you know, there you go.
Yep. Yeah, I Have the Tiger. That's
straight to the top.
Now, who is it? Who played Eye of the Tiger? Europe, or who was Eye of the Tiger?
Survivor.
Who was it?
Survivor.
My bad. Europe Survivor. I was close. Okay. No, that was awesome. Yeah, I remember watching Wittenberg University in Springfield, Ohio. They were the Tigers. They come out to Eye of the Tiger. So it was always cool when I was a kid watching that. The basketball. All right. Anyway. All right. Sonu, thank you so much for the music update there. Thanks to everyone who continues to listen to this. Thanks, Chelsea, our producer. Went a little long, but hopefully you enjoyed some of this stuff. We hope everyone had a happy and safe Labor Day holiday. By the time you listen to this, Labor Day would have already happened. And with all that, we'll be back next week in the latest Carson's Facts versus Feelings podcast. Probably not going to have any guitar, but we'll bring the guitar out very, very soon. Take care, everyone. Thank you.